The big thing for investors to think about today is just generally speaking, kind of how does real estate fit in the current environment? And, again, we're seeing fairly strong inbound call volume from investors looking to get exposure to REITs today.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Sahn, Managing Partner and Portfolio Manager at Hazelview Investments, an active investor, owner, and manager of real estate investments. Sam manages Hazelview's global real estate security strategies and is here to talk about the opportunity set within public real estate today. Sam, thanks for joining the podcast.
Thanks for having me, Sarah.
So, Sam, how would you describe investor sentiment in recent years towards real estate and REITs specifically, and what's been behind that?
Yeah, it's a good question. It's been negative. It's been very negative. Since COVID, there's been two twin shocks that have taken place. You've had COVID and the viability and people questioning the viability of asset classes across the board in the world of real estate, where people are going to travel again, were people going to shop inside a mall again? Were people going to go back to the office, which is still continuously being debated? Senior housing was a property type that came right under a lot of scrutiny given what was happening with mortality rates and where. So there was a lot going on with respect to questioning the demand profile for a lot of asset classes in 2020 and 2021. And then inflation happened. Interest rates went up 500 basis points in several years. Private market values declined. Apartments were down over 30%. Office was down more than that. Retail in the 20s. And there was a lot of investors who avoided investing in the asset class, publicly and privately. Over the last 5 years, you've had 40 billion of outflows that have come out of the sector, out of ETFs and actively traded funds. So the sentiment has been very negative. And coming into this year, what we've seen is the positioning with respect to generalist investors, long-only investors, hedge fund investors as it relates to real estate compared to other GIC sectors was the lowest it's been in 5, 6, 7 years. Most of those cohorts have been underweight real estate. And you could see that in the total returns. Since the start of 2020, the compound annual return or the cumulative total return for global REITs has been just 10.5% as of the end of 2025. That compares to global equities at 112. So right there in that performance delta between the global REIT industry and REITs as an asset class and equities tells you how negative investor sentiment has been. But we're starting to see that change.
Yeah, can you talk a little bit more about that shift in sentiment and how fundamentals are behind that?
We are seeing today more inbound phone calls from potential investors that are interested in increasing exposure to REITs and real estate in general. Like I said before, they've been out of the sector for the past 5 to 6 years, or they've been underweight, and they're looking to increase that allocation today. Investors are looking for exposure to hard assets. They're looking for asset classes that give them cash flow stability. They're looking for income. They're looking for diversification, liquidity, all of which REITs provide.
And what about the trends that you're seeing, or the convergence of trends between US REITs and global REITs? How is that varying?
It's interesting. If you look at 2025, you had significant variability in performance by region. So if you just take the US as an example, the US was the worst performing REIT market in 2025. But so far this year, REITs in the US are starting to regain their footing. REITs as an asset class were up 2 to 3% last year. So far to start the year, if you run it through today, they're up mid-single digits, 6, 7%. That compares to S&Ps, the S&P 500, which is down. So we're starting to see an improvement in the performance of US REITs. You're starting to see continued growth in markets like in Japan and Hong Kong. Japan and Hong Kong were two of the strongest REIT markets last year. Japan was up 39%. Hong Kong was up mid-30s. This year, Hong Kong and Japan is continuing to lead the pack. So that trend is continuing. Especially in Japan, you're having an economic resurgence. That resurgence is giving landlords the ability to raise rents. And those higher rents, those higher asking prices, that's having a positive flow through to real estate cash flow. In Hong Kong, you're seeing a recovery in the residential market. That improvement in the residential market is having a positive influence on stock prices. Now, when you unpack it at the property type level, data centers is obviously a topic that gets discussed widely and broadly. Within our world, data centers was a significant outperformer in 23, significant outperformer in 24, but lagged in 25. That is doing 180 so far this year, and data centers are off to a very strong start, with leasing demand continuing to persist despite fears that it may not. Lastly, retail. Retail fundamentals are also very strong, and we're seeing that across all three regions. We're seeing that in the US, we're seeing that in Europe, we're seeing that in Asia, a lot of which is driven by strong appetite from retailers for space because of consumers spending at bricks and mortar stores. And the other half of it is supply. There is very little supply today of new construction around retail. That's discretionary retail, non-discretionary retail, and the limited amount of supply is having a very positive impact on market rents and occupancy rates.
So, Sam, in your mind, is there a sort of optimal balance between US and global real estate right now?
Yeah, we see more attractive opportunities in the US today on the margin. We're seeing opportunities. We talked about data centers. We talked about retail. We think the valuation disconnect in the US is very attractive. Since the start of COVID and through year end of 2025, REITs in the US experience over 30% of multiple compression. That is a significant decline in valuations. We talked about how the US was a big underperformer in 25 compared to other markets in Asia, like Hong Kong, Japan, and Singapore. So as we look at the world today and over the next 12 months, we're seeing more opportunities in the US than we have over the last several years.
I wanted to ask you more about the valuation gap between public and private real estate. We've seen quite a few go private announcements lately. How do you see that trend panning out?
We think it continues to persist. There is a tether between public market valuations and private market valuations. And when there is a significant disconnect, like you see today, between where the public companies trade and where assets are trading in the private market, you are going to see smart, sophisticated, intellectual capital come in and take advantage of that valuation arbitrage. As we entered 2025, we saw on our valuation approach, which is a two-pronged approach. We use NAV, we use cash flow, a 17% discount to intrinsic value, and 10-year trailing returns at cyclical lows. That can only persist for so long. And with interest rates becoming less of a headwind than it was in 22, 23, 24, and for the most part, the beginning of 25, we are going to see continued M&A, continued go private transactions, and we think that happens across multiple asset classes.
And you've already touched on this a bit before, but where do you see the most compelling REIT opportunities right now?
You know, we did touch upon data centers. We do think that asset class in particular is prime to see very strong growth in cash flows, growth in revenues, growth in EBITDAs. The leasing demand from both the hyperscale segment as well as the 0 to 1 enterprise segment is exceptionally robust. Power is the great limited availability factor as it relates to being able to see more customers to move into the space and hit their capacity needs. We think market rents continue to rise. We think vacancy rates in the US, especially in those core cluster markets, are at all-time lows. And the data center sector is going to experience very strong fundamentals over the next 1, 2, 3 years. As it relates to other property types, we think senior housing is going to see strong secular growth over the next 5 years. That demographic boom of the baby boomers aging and needing more care as they age is exceptionally strong. That's leading to rising margins, rising occupancy rates, rising asking rates, and that's coupled in an environment where supply is continuing to go down. It's really hard for developers today to construct new senior housing facilities, whether it be land costs that are higher over the last 5 years, hard costs that are higher, construction lending in general has become more punitive. So developers need to pony up more equity at the beginning of those deals. We think that demand supply imbalance will continue to persist. And for existing owners of senior housing facilities, that's going to lead to very strong growth in NOI over the next 3 to 5 years. Another sector I would probably touch upon is industrial. Industrial caught a bit of a headwind around Liberation Day a year ago. Demand softened, tariffs injected instability and uncertainty in leasing decisions. We think we're through a lot of that despite what's happening right now geopolitically and whatnot. So we do see a recovery in the industrial market. That recovery is in the US. It is in Europe. It is around supply having peaked, vacancies having peaked, and we're going to start to see that come in over the next 12 to 24 months, which is going to lead to improvements in leasing demand, leasing velocity, occupancy rates, and eventually market rents.
And Sam, you were recently in Florida for the City REIT conference. Were there any trends or themes that struck you as interesting during that time?
Outside of the sun, and the warm weather, which a lot of us did not get the opportunity to enjoy because we spent most of our time indoors meeting with peers and companies within the space, I would say a few things stood out. One is investor sentiment was positive. Couldn't say that over the last 12, 24, 36, 48 months. I think the tone in the room, the tone at the conference was much better than what it's been over the last several years. I think two, companies are seeing the disconnect in valuation between where their stock is trading and where assets in the private market are trading. And they're looking to sell what they view as non-core properties to buy back stock. So share repurchases was a big topic across many of the meetings that I attended. Look, generally, that is one tool in the toolkit for companies to leverage to be able to unlock value. When you can sell assets at NAV or at retail prices and you can buy back your stock at a discount, that's a good capital allocation decision. Third, I would say fundamentals. Fundamentals are largely strong across most property types, outside of a few sectors that are experiencing excess supply today, like life sciences, like cold storage. So we think fundamentals continue to inflect up and to the right. Occupancy rates is a great example of that, right? Occupancy rates generally are fairly high. It's giving landlords the ability to have pricing power over their space. I talked earlier about retail. Retail in particular, I think, stood out at the conference. They're seeing really good strength in leasing demand and senior housing as well, I talked about earlier. And then I think finally, it's just a focus on growth. It's growth through acquisition. It's growth through using your cost of capital to make good investment decisions and to buy accretively to drive earnings higher. I think there was a lot of conversation at the conference around how do I use my improved cost of capital to make strong returns for shareholders.
So would you say that competition for assets is really intensifying?
For some property types, yes, but for others, no. You look at the office sector, don't think really the competition for assets there are intensifying. But when you look at apartments, there seems to be still a strong bid in the private market, and cap rates for apartments privately are trading somewhere in the mid to low fives, but the apartment REITs, their implied cap rates are in the low sixes. That's two illustrative examples of a property type where private bid is soft and one where the private bid is strong. The big thing for investors to think about today is just generally speaking, how does real estate fit in the current environment? And again, we're seeing fairly strong inbound call volume from investors looking to get exposure to REITs today. I think you're seeing that flow through to the performance of the asset class to start the year. And I think it leads to stronger returns going forward. When you take a step back and look at what have been the trailing returns for REITs, and that could be REITs in the US, could be REITs in Europe, REITs in Asia, those 10-year trailing returns are at cyclical lows. And that's a reflection of everything we talked about that has happened to the asset class since COVID. Going forward, all signs point to those trailing 10-year returns improving, and improving in a way where we start to generate what used to be high single-digit, low double-digit returns. And that's our expectations for 2026 and beyond.
Excellent. Sam, thanks so much for your time.
Thank you, Sarah. Thank you for having me on.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.